Investors generally use screens to find attractive investing opportunities. And today we're going to go through an example of a passive equity screen. We come up with a list of public equities and then couple it with an intrinsic valuation of that specific public equity to see if we can find attractive investment opportunities. It is important to consider the time horizon of an investor, taxes, and transaction costs, and of course, proxies for risk as we come to select the attractive investing opportunities that are cheap, but they don't deserve to be cheap. Otherwise, transaction costs and taxes eat away the paper returns, the paper portfolio returns that we seek to realize. So the topic of today is passive equity screening, and I want to determine how we can set up these screens. What we're looking for and our objective is to look for a mismatch between the pricing of the company and the fundamental drivers of the company, the fundamental drivers of valuation of the company, and that is cash flow, growth, and risk. So we would screen for price to find cheap companies, but we would also want to find companies that don't deserve to be trading at those very low multiples. Therefore, we would screen for risk. We would screen for growth, and we would screen for the quality of growth because we would have to pay for that growth. So what we're looking for is cheap companies that are trading at low multiples, but they have high growth prospects, they have high quality of growth, and they have low risk. So let's see how we can determine the measures for these screens. One thing to remember is screening alone does not lead to success, as we have to bring something unique to the table, and in this case, for us today, is intrinsic valuation. Otherwise, any type of machine can replicate these screens. To screen for price, we look at multiples. As we're seeing here, we have screened for price looking at 3 different multiples. But how do we pick these multiples? We would either pick equity multiples or fair value multiples that are consistently defined and uniformly estimated. What does that mean? It means the numerator and the denominator of the multiple that we pick, just a price to book or a price to earning, are the same claim holders of the company. So these two are equity multiples, or EV to EBITDA multiples that are firm value multiples. Once we pick our suitable multiple, the best way is to look for a distribution of these multiples. So in this case, we have looked at North American public equities, and we have a list of all of the equities in the North American market in this case, and we have their market cap, all of their different statistics, their ratios, the fundamental drivers. But the best way to determine if the multiple is high or low is to look at the distribution of the multiples, the cross-sectional distribution of the multiples, which we've done in this case. We have looked at the deciles of the data, and we can look at the top quartile or the bottom quartile at the distribution of the price to earnings, price to books, or EV to EBITDA multiples, rather than looking at point estimates. For instance, defining an EPE ratio above 8 is large, or why 8? So as time goes by, as the sample changes based on the companies that are within the sample or outside of the sample, these numbers would change. So the best way is to look at the distribution. Then we come to risk, cash flows, growth, and risk. So in this case, we have looked at leverage. To screen for risk, we can look at several different categories. We can look at operating risk, we can look at financial risk, we can look at liquidity risk. Liquidity risk is in the case of bid-ask spreads and looking at share turnovers and the trading volumes. For financial risk, obviously, one way is to look at leverage, which that's what we've done here. We have looked at net debt to net capital, invested capital ratio, or debt to cap ratios. And then we have looked at the deciles of the data. And based on the deciles of the data, we can determine what's the top quartile, what's the bottom quartile. what is the top half or the bottom half of the data. We can look at and consider beta. So that's price-based measures of risk. So beta of a stock, or the volatility of a day-over-day returns of the stock. Or we can look at multiples, accounting multiples, like at investment coverage rates, like interest coverage ratios or fixed charge coverage ratios. We can look at sector-specific ratios. For instance, if we're looking at a financial service industry company or specifically banking, we might look at regulatory capital or the amount of regulatory capital the company has, or specifically bank has. The higher the regulatory capital, the safer the company. Whatever measure of risk we pick, whether it's a price-based multiple or whether it's a price-based measure or whether it's a financial measure like we've done here, or operating risk measures, pick one and stay consistent. Now we move on to growth. For growth, it is best to look at forward expected growth. Valuation is always forward-looking, so looking at historical growth is not going to provide much information. And in this case, we have looked at growth rate estimates for earnings, EPS, or operating income, or net income. And these numbers are in percentages. So what we have done is that we have looked at their estimate of growth, the forward-looking growth. We can look at a 5-year estimate of growth and pick the top quartile, the bottom quartile, or above median or below median. Finally, last but not least, we have the pay for growth, and it's important to look at the quality of growth, and that's determined through return on capital and return on equity of the stock, which is operating income over invested capital, and in terms of return on equity, it's net income over equity. It's important to have positive excess return, of course, because return on equity or return on capital would have to be above the cost of equity or cost of capital of the company for a company to have positive excess return and for growth to add value. Otherwise, growth destroys value if these excess returns are negative. Today, we have looked at the distribution of the data. We've looked at the distribution of the data and we have picked our screens. Before we go through how we're picking these screens after collecting all of this data and determining what type of measures we're going to use for each screen, it's important to determine two issues. If upon selection of these numbers and measures and setting limits for the screens, we come up with a sample size that is too small, that means our screens are too tight. The other issue is that once we run these screens, if there's sector concentration or there's a common factor that is repeated across all of the results that's coming out of the screen, then we have to remodify the screen because it appears that there is a risk factor or there is a factor within our screen that we're not covering. To recap, what we're looking for is cheap companies that have a low leverage and stable growth prospect. They have liquid assets, and we can have a margin of safety as well for our screens. But overall, we're looking for a mismatch between the pricing of the company and the fundamental drivers of the company. So in terms of equity screens, we have looked at price to earnings ratios, and we look for a low price to earnings ratio. So we look at the bottom quartile below the 30th percentile of the data. So in this case, anything below 13.9. And then we have looked at the net income growth. And for net income growth, we have looked at the above the median value. So that's the 50th percentile of the data. So anything above 15, anything above 15 is considered higher growth. And for debt, in terms of measure of risk, we have looked at the bottom quartile, so anything below the 30th percentile in terms of leverage, and of course the return on equity. These are equity screens. So what we look for is the equity version of all of these multiples, the return on equity, the growth in the net income or earnings per share, and price to earnings ratios. If we were to look at the enterprise value screens, then we would look at EV to EBITDA, we would look at above average or above median revenue or operating income growth. We have looked at leverage, low leverage, which is below median, and of course, high return on capital. So we ran these screens over all of the companies in the North American market, public companies, publicly traded companies. For the equity screen, we came up with 3 companies. It's low, but the good news is that there's no concentration. We have gold, we have consumer electronics, home furnishing, retail, and their size are different, mid cap and small cap. So it means that our screen is capturing all of these different risk factors and different drivers. For firm value or EV screen, in terms of a look at EV to EBITDA screen, again, we have come across companies with different sizes and, of course, different sectors. Today, we're going to go through the companies that have come out of the equity screen. And the specific company that we're going to look at is Kirk, given the pandemic and the home furnishing retail. Home furnishing retail sector has been one of the retail sectors, the discretionary retail sectors that have been significantly impacted by COVID-19. So it's interesting to see if the companies in this sector would make suitable post-pandemic trade. So let's go through Kirk Lansing, a home furnishing retailer that's topped the passive equity screen list. So we want to couple our screening, in this case the passive equity screen, with intrinsic valuation. Kirkland is a home furnishing retail company that has come through the screen with a price to earning multiples and a debt to cap ratio that's in the bottom quartile of the North American equities that we screen for, and it has a high cash balance and above market median earnings growth and above market median return on equity. So it has a median growth with respect to the companies in the public equities, and of course, it has a high quality of growth given the return on equity. It's a micro-cap company, so there is a liquidity factor of it. But looking at how the stock has traded, we noticed that during the pandemic, the stock crashed, almost trading at the penny, 65 cents in mid-March when it was the peak of the pandemic, and it's come back ever since. In terms of the business strategy, Kirk is a leading home furnishing North American market that prides itself as a value-oriented home decor retailer. It allows customers to furnish an entire home at a budget. So they are competing on price. They have also been transforming their e-commerce strategy given the growth of the e-commerce and innovation across the globe. And of course, they're closing money-losing brick-and-mortar stores. They're significantly investing in the omni-channel, and the omni-channel is becoming a crucial contributor to the revenues. During the pandemic, and specifically in the first quarter of fiscal year 2020, they closed all of their stores, and of course, they increased borrowing to $40 million. Generally, borrowing in the company is only in terms of operating leases, and it does not have any other debt other than the operating leases of the company, but they borrowed $40 million from the revolver, which they immediately returned in the subsequent quarter. And of course, we know that during the pandemic, there were supply chain hiccups that the pandemic had caused as a result of the shortage of raw material. And of course, retailer that takes prizes as a value home decor has also been impacted by the pandemic. With respect to their product, the demand for Kirk's discretionary retail furnishing products are extremely cyclical. It's heavily dependent on consumer disposable income, the amount of debt, the mortgage market, and housing, given that we have to furnish the houses. And the demand for their products significantly declines during recessionary environment, which is what's happened to the stock price during the pandemic. So let's look at the operation of the business historically and look at some of their metrics and historical performance from a financial standpoint. When we're looking at company, we not only look at earnings, but we also look at accrual. We don't not only look at accrual, but we also look at cash earnings. So we looked at the cash flow, operating cash flows, and of course net income. And if we look at the ratios of net income to net operating cash flows and net income, we see that the ratio is consistently positive and it's increasing within the last 2 years, especially post-pandemic. So it does mean that the earning quality is good. The company has good earning quality. From a cash flow perspective, if you look at this, there are certain specific ratios such as interest coverage ratios. We can look at the amount of debt the company has, debt to LTM EBITDA, last 12-month EBITDA, and we look at returns in terms of cash flow returns. It's been strong, and they have a really low debt burden, which has helped them during the pandemic. So they have been significantly beaten up during the pandemic, despite the fact that the demand of the product might have gone down, specifically in the middle of the pandemic, given that the products are discretionary retail. They didn't deserve to go down as much. And if you look at their ratios, from an operating standpoint, operating margins and net margins, which are shown in the bold lines, as we see both blue and gray lines, they have been below the industry average. So from an operating perspective, you can also look at their return on capital and return on equity. Generally, it's been below the furnishing industry average. So from an operating perspective, the company has been weak. Operating efficiency perspective has been weak, but it's coming back. And given their targets, they target the company, and specifically the management, given the guidance that they would give, is that they believe, given the investment in the omni-channel, given the closure of money-losing stores, that the EBITDA margins would be in the high single to low double-digit range, and the operating margins would be in the mid to high single-digit range within the next 2 to 3 years. And surprisingly, if we look at the quarterly financial statements over the last 3 quarters, they have been able to hit the margins and deliver on the margins that they have described in the financial statements. If we look at leverage multiples, and of course, looking at their balance sheet strength from a leverage perspective, the total debt to EBITDA, given the EBITDA has been negative in this specific year, but the interest coverage ratios have been strong. If we're looking in this secondary axis, they can meet their interest of the operating leases. But from a balance sheet perspective, this cash as a percentage of firm value has been quite high, which is displayed here in the blue bars. It's 12%. It's above the industry. It's above the furnishings industry average. And of course, debt to cap ratio is 65%. But the current ratio has dipped below 1 in 2019 and 20 amidst the pandemic, but it's ever since coming back. So overall, the balance sheet quality is strong. And of course, from a valuation perspective and looking at the price to sales multiples, it's below the median industry average. But before we actually make a judgment that if this company is undervalued or not, we have to determine if the fundamental drivers of price to sales multiples actually justify this company trading at that specific multiple. And why do we pick price to sales multiples? It's a retailer. Retailers are driven by margins. Price to sales ratios are driven by operating and net margins, specifically price to sales by net margins. Value to revenues is driven by operating margins. In this case, we look at price to sales multiples. The company has been around since 1966. It's been a private company later on. It's gone public through an IPO in the 80s in 1981, and it's got subsidiaries. But looking at only the age of the company, we cannot determine the corporate life cycle. Best way to determine what stage of the corporate life cycle the company is at is to look at their revenue, operating income, or operating cash flows. And if we look at the sales, in this case, operating cash flow, it's been growing aside from 2019 and 20 and the pandemic. If you normalize those numbers and exclude that specific year due to the recessionary environment, we can see that the earnings are growing. So it's a high growth to mature stage company within their corporate life cycle. The company is specifically quite cyclical and seasonal, and the bulk of the earnings are, or another way of saying it, the holiday season and Thanksgiving disproportionately contribute to the earnings. That's the story of the company historically, a discretionary retail company that is low levered. It gets enough liquidity and cash, quite a significant amount of cash on the balance sheet. It does not pay a dividend. It only does historical share buybacks. And the operations are cyclical. And during the pandemic, Small cap cyclical companies and retailers were significantly beaten up. With the post-pandemic economic recovery in 2021, beaten up smaller cyclical stocks such as Kirk make perfect candidates for recovery trade. And of course, looking at an outlook for the furnishing retails, given the remote work, the demand for the products, especially specifically office furniture, are going to be consistently increasing. Let's look at the valuation of the company specifically, and then we look at the management and ownership of the company. From an intrinsic value perspective, we look at the operating cash flows, and we come to the free cash flows of the firm through subtracting the reinvestment, which is in this case net capex and net working capital, from the free cash flow from the operating cash flows after tax. So that part of it is quite straightforward, and we have done a three-statement analysis, three-statement model, and forecasted it. But the interesting part of the valuation of this company is in the risk in the company. The company this microcap company became significantly illiquid during the pandemic. And we know that the stock price crashed and to 65 cents in the midst of the pandemic, and that's pretty much a crash. But we can look at the trading volume, and we can look at the bid-ask spreads. The bid-ask spread as a function of closing price, and we can see that it's peaked during the pandemic, and that's an indication that the stock became illiquid. We can look at share turnovers, and it's been increasing. The amount of the daily trading volume over the share float in the market, and it's been peaking during the pandemic. And of course, the trading volume itself was increasing. Everybody was selling. There were not that many buyers. So the stock became illiquid, and it's a microcap company, and that's how we're going to introduce it into our valuation, is through adjusting the cost of equity. The currency that we pick, which is in the US dollar, is reflected in our risk-free rate. The markets we're operating in, which is North America, is reflected in our equity risk premium, which is in this case equity risk premium in the mature market, and equity risk premiums are have been coming down since the pandemic. Then we look at levered beta and unlevered beta. We look at the bottom-up beta to come up with the beta of the company, in this case for furnishings retail, given the leverage that the company has, to look at the risk of the company with respect to the market. But in order to introduce the illiquidity discount or illiquidity premium into the cost of equity, we look at historical bid-ask spreads and the cost of equity and determine that every 1% increase in the bid-ask spread over price, the ratio of the bid-ask spread over price, will increase our cost of equity by 25 bips. And that's how we increase our cost of equity as a result of it. However, the stock has become liquid post-pandemic. This does not add too much of a discount, too much of a premium to the cost of equity. For cost of debt, we choose the level of riskiness of operating leases at 7%, and of course we come up with a WACC of 6%, and as our leverage changes throughout the years, keeping the risk-free rate constant, although the risk-free rate is going to increase given the increase in inflation and the fact that the Fed Reserve are going to stop buying bonds, and we're going to have, and they're going to increase rates. All those rates are going to get reflected, but the valuation is going to remain bounded, because what one hand gives you, the other hand takes away, because the inflation increase would impact the top line. So considering these discounts, we can come up with an enterprise value, or the value of the operating asset, at $731 million. We take out net debt, we take out options. The value of the options is done through a Black-Scholes model, looking at the risk-free rate, the term of the option, which is about 6 years, the volatility of the stock, which is about 93 years, and it was quite high due to the pandemic. And we come up with an implied market value of equity of $621 million. But that gives us the $43 equity value, implied share price. But do we have conviction on this price? In this case, we went and looked at the investors in the company. And when we look at the group of investors who are investing in the company, 71%, or to be exact, it's roughly about 70% of the investors, 50%, 51% are institutional investors, and 22% are hedge fund managers. So that's about 72% of the company is, or 73% of the company is held by institutional investors. The institutional investors are considered marginal investors. Some of these investors are smaller investors, and the portfolio and the risk of their portfolio with respect to the market is reflected in a concept called total beta. It's dependent on the beta of their portfolio with respect to the market, which is supposedly higher than the market beta. So potentially the levered beta could be increasing and it could be higher than what we have arrived at here. As a result, given the liquidity and given the institutional default and the ownership, we applied a discount still at $34.79. The stock is 81% undervalued. So the return to target, given the current price of $19 as of the date of the analysis that we have done, which has been July 16th of 2021, the stock is 81% undervalued. We introduced a margin of safety in our original equity screen when we were running the passive screen, is that we can introduce a margin of safety to see what's our comfort level. If we were to supposedly introduce it at 50%, 81% is still above it. So our intrinsic value validates that this company is significantly undervalued. Another way to look at this is also to do a relative valuation with respect to the peers. The peers have been selected through a study of all of the in-market companies, specifically in the furnishing and retail industry, looking at companies with similar cash flow growth and risk characteristics. And some of these companies are also mentioned in their financial statement and competitors and peers of these companies. And if we look at the forward EV to revenue, enterprise value to revenue, or price to revenue, or price to sales multiples, we come up with a range of $31 to $38 of share price. So overall, we have looked at the valuation of the company. So the valuation of the company tells us that this company is significantly undervalued. One other thing we would look at when we're looking at companies and their valuation is the management team, which is an important part of it, and of course the risks. They have a strong management team. The management team owns 5.57% of the stocks in the company, which gives them conviction. It actually allows them to act like owners rather than managers, and to the benefit of the shareholders of the company. Because the better the company does, the compensation and their ownership would increase in terms of equity value and the options that they have. So, however, there's an institutional default that about 72%, 73% of the company is held by institutional investors that during times of trouble, they sell and move on. The company has also introduced 2 new members to the management team, the new Chief Technology Officer and the VP of Marketing, which means that this company is consistently investing in technology and the omni-channel enhancement, and that's going to be a strong driver of the revenue in the coming years. So they're investing in the e-commerce growth. From a risk perspective, of course, it's a discretionary retail company. Kirkland is exposed to market risk and credit risk, and all of the risks as a result of the pandemic, supply chain risk, the fact that inventory might run down, there's shortage of raw material, the inflation, as inflation rises, it will impact the cost, and the cost would increase. And of course, they buy the raw material and merchandise from countries such as China, and the dependence on these companies and the tariffs between the United States and restrictions of the economic restriction between these 2 countries would impact the operations of this company as well. The rapidly changing consumer shopping habits would impact the company. And of course, if they do not foresee what's coming ahead of them, they might not be able to deliver on their corporate strategy. But overall, despite all of these risks, the valuation, the intrinsic value of the company is telling us that this company is 81% undervalued. And of course, the company crash is the beaten up quite bitten up during the pandemic, and it makes a good recovery trade in a post-pandemic environment, especially as a cyclical smaller cap company. To recap, we went through the process of a passive equity screening for cheap companies that don't deserve to be cheap as a result of their fundamental drivers of the companies, of the multiples. So we looked at cheap companies that have low leverage and stable growth prospects, liquid assets, and of course, high quality of growth. And we came up with a list of equities, and we coupled it with intrinsic valuation and determined if the intrinsic valuation backs up our judgment with respect to the value of the company.